Good afternoon, class. I hope you are well. I also hope that my connection doesn't play a trick on me this time. Anyway, this is the coverage of Chapter 13. Chapter 13 is a review of international equity markets. More specifically, we will cover these topics. We will examine the market structure, the trading practices, and the cost of trading in international equity markets. We'll look at the factors affecting international equity returns. Anyway, these are the topics that are going to be covered. So let's get started. At year end 2018, the total market cap of the 80 organized stock exchanges tracked by the World Federation of Exchanges stood at $74,667 billion. The five largest stock exchanges at the end of 2018 are the New York Stock Exchange in the US, the NASDAQ also in the US, the Japan Exchange Group, the Shanghai Stock Exchange in China, the Hong Kong exchanges and clearing. So those are the five largest stock exchanges as of the end of 2018. Market liquidity is a very important concept. Okay, a liquid stock market is one in which investors can buy or sell stocks or sell securities in general quickly or close to the current quoted prices. In other words, you can sell without having to take a significant haircut or a significant loss. A measure of liquidity for a stock market is the turnover ratio, which is calculated as the ratio of stock market transactions over a period of time, for example, a quarter or a month, divided by the size or market cap of the stock market. Though, the higher the turnover ratio, the more liquid the secondary stock market, indicating ease in trading. In 2018, many national stock exchanges had relatively high turnover ratios, with close to 40% of the exchanges in excess of 30% turnover on average. Market concentration is another important concept. Investors difficulty diversifying their portfolios or their investments in concentrated markets. That is, those markets dominated by a few large players or a few large firms. Concentrated financial markets also represent a poor access of firms to the stock market. Now, how do we measure market concentration? A common measure of stock market concentration is the ratio of the market cap of the largest 10 companies divided by the total market capitalization. In other words, you take the market value of the 10 largest companies, and that value is then divided by the total market value of the stock exchange. In 2018, the largest 10 companies on the Budapest Stock Exchange accounted for a whopping 94.46% of the total market cap of the stock exchange. That's a very high concentration, very, very high concentration. Okay. Alternatively, though, also in 2018, the London Stock Exchange had a much lower concentration ratio of slightly under 30%. Now we cost. The secondary equity markets of the world serve two main purposes. They provide marketability they also provide share valuation. They provide a way, to value securities. In this case, stocks. Now, investors who buy shares from the issuing firm in the primary market may not want to hold them indefinitely. The secondary market allows those share owners to reduce holdings of unwanted shares and purchasers to acquire the stock. When conducting a trade in the secondary market, public buyers and sellers are represented by an agent known as a broker. Orders submitted to the broker may be a market or limit order. A market order is executed at the best price available in the market when the order is received, that is, the market price. By contrast, a limit order is an order away from the market price that is held in a limit order book until such a time when it can be executed at the desired price. Let me give you an example of a limit order. Suppose you are interested in purchasing a certain stock, which I'm going to call XYZ. Now, the price of XYZ, the current price of XYZ is, say, $20. You want to buy it, but you don't want to pay $20 because you think XYZ is going to come down in the near future. So what do? You place a limit order to buy, and you set your limit price at, say, $18. In so doing, you are instructing your broker to purchase a XYZ when it begins trading at $18. Now, you may also currently, own XYZ. Maybe XYZ is part of your current portfolio. XYZ, again, remember, is going for $20 a share. You want to sell, but you do not wish to sell for 20 because you think XYZ is going to appreciate. You think XYZ is going to gain more value. So then you call your broker and you instruct your broker to sell XYZ at a price of 25. Obviously, that order is not going to be executed right away because XYZ is currently trading at $20 per share. So your order is going to be held in a limit order book awaiting execution. Of course, there's no guarantee that your order will ever get executed. If XYZ never reaches $25, your order will never get executed. Now, secondary markets may have different designs that allow for the efficient trading of shares. Generally, a secondary market is structured as a dealer or agency market. In the dealer market, the broker takes the trade through the dealer who participates in trades as a principal by buying and selling the security for his or her account. Now, in an agency market, by contrast, the broker takes the client's order through the agent who matches it with another public order. Now, both dealer and agency structures exist in the United States. Here are the characteristics of major equity trading systems. Okay. If the equity trading system is a dealer system, then public orders go through a dealer. The order flow is continuous. An example is the NASDAQ/OTC market in the United States. Okay. Now, if the equity trading system is an agency system, then agents, as I explained earlier, assist with the matching of public orders. Now, the order flow may either be continuous or periodic. Okay. An example is the Nice market or the old Paris bourse. Now, if the equity trading system is fully automated, then public orders are electronically matched, right? And the order flow is continuous. One example is the Toronto Stock Exchange. There are approximately 80 major national stock exchanges. Western and Eastern Europe once had more than 20 national stock exchanges where at least 15 different languages were spoken. Possibly, though, over time, a European stock exchange will eventually develop. However, a lack of common securities regulations, even among the countries of the European Union, hinders this development. Today, stock markets around the world are under pressure from clients to combine or buy stakes in one another in order to trade shares of companies anywhere at a faster pace. Trading in international equities. During the 1980s, world capital markets began a trend toward greater global integration due to the following factors. Investors began to realize the benefits of international portfolio diversification. It has well been, it has long been documented that equity markets are not really fully integrated, right? So it is possible to purchase assets in different markets and in the end reduce your risk rather significantly. Okay. Major capital markets became more liberalized. New computer and communications technology facilitated efficient and fair securities trading. Multinational corporations realized the benefits of sourcing their capital internationally. Okay. So all of these factors here have contributed to greater and greater global integration. Cross-listing of shares. Cross-listing refers to a firm having its equity shares listed on one or more foreign exchanges in addition to the home country stock exchange. Say, for example, you are a Canadian-based company. Your shares are listed on the stock exchange. You may also choose to have your shares listed on the New York Stock Exchange. That is considered cross-listing. Cross-listing, though, is not a new concept, but its amount has exploded in recent years due to increased globalization. Multinational corporations often cross-list their shares, but non-multinational corporations may choose to cross-list as well. A firm may cross-list its shares for many reasons. Cross-listing provides a means for expanding the investor base for a firm's stock, potentially increasing its demand, which is a good thing. Cross-listing establishes name recognition of the company in a new capital market. Once again, you are a Canadian company. You may choose to cross-list your shares in Paris so that folks over there in Paris then become familiar with your company. Cross-listing brings the firm's name before more investor and consumer groups. Again, name recognition. Cross-listing may be a signal to investors that improved corporate governance is forthcoming. cross-listing into developed capital markets with strict securities regulations and information disclosure requirements. Finally, cross-listing may mitigate the possibility of a hostile takeover of the firm. Yankee stock offerings is a relatively new phenomenon. Yankee stock offerings are sold directly to U.S. investors by foreign companies. Now, you may want to remember Yankee bonds. Okay, we covered this in our prior chapter, right? Say, remember, if a Canadian company issues bonds in the U.S. denominated in U.S. dollars, that is a Yankee bond. Likewise, if a Canadian company raises funds in the U.S. and again in U.S. dollars, the funds are raised in U.S. dollars, that is called a Yankee stock. Since the beginning of the 1990s, many foreign companies, Latin America in particular, have listed their stocks on U.S. exchanges to prime the U.S. equity market for future Yankee stock offerings. Three factors appear to be fueling the sale of Yankee stocks: the push for privatization by many Latin American and Eastern European government-owned companies, the rapid growth in economies or in the economies of developing countries, the large demand for new capital by Mexican companies following the approval of NAFTA, the North American Free Trade Agreement, which was replaced recently with a new accord. Under President Donald Trump or former President Donald Trump. American depository receipts. Okay. Foreign stocks can be traded directly on a national stock market, but frequently they are traded in the form of a depository receipt. And that begs the question, what is a depository receipt? Depository receipts market has grown significantly over the years. In 2018 alone, $15 billion was raised through 49 depository receipt offerings. And this is the answer to my earlier question. My question was what is a depository receipt? Well, an American depository receipt, or ADR, is a receipt representing a number of foreign shares that remain on deposit with the U.S. depositories custodian in the issuer's home market. I've done some research on this, and I'll talk to you about that in a little while. The first ADRs began trading in 1927. So yes, they okay. What are the advantages of ADRs? Investment advantages of ADRs include the following. ADRs are denominated in dollars, trade on a U.S. exchange, and can through the investor's regular broker. You can call up your broker and say, well, I want to buy this specific ADR. Dividends received on the underlying shares are collected and converted to dollars by the custodian. ADR trades clear in 3 business days, as do U.S. equities. ADR price quotes are in U.S. dollars. ADRs, with the exception of Rule 144A issues, are registered securities that provide for the protection My internet connection again. Okay. Investment advantages of ADRs include the following. An ADR investment can be sold by trading the depository receipt to another investor in the US stock market, or the underlying shares can be sold in the local stock market. ADRs frequently represent a multiple of the underlying shares rather than a one-for-one correspondence to allow the ADR to trade in a price range customary for US investors. ADR holders give instructions to the bank as to how to vote the rights associated with the underlying shares. There are two types of ADRs, sponsored and unsponsored. Sponsored ADRs are created by a bank at the request of the foreign company that issued the underlying security. And this is the only type that can be listed on the US Stock Exchange. Now, unsponsored ADRs, by contrast, were usually created at the request of a US investment banking firm without direct involvement by the foreign issuing firm. Consequently, the foreign company may not provide investment information or financial reports to the depository on a regular basis or in a timely fashion. Right? There are different levels of ADRs, level 1, level 2, level 3, and then we have rule 144A. And level 1 is the most basic type of ADR. Under level 1, the issuer is not seeking to raise new capital in the US and or cannot list on the NASDAQ stock exchange. Okay, under the first level, they cannot list on the on the NASDAQ. With level 2, the issuer is not seeking to raise new equity capital in the US, and the ADR can be listed on the NASDAQ, the Amex, and the New York Stock Exchange. With level 3, the issuer floats a new offering in the US Amex as well as on the New York Stock Exchange. Now, Rule 144A, this type of ADR program is a private placement of equity to qualified institutional buyers. Only sophisticated investors can be present here. Global registered shares. The merger of Daimler-Benz AG and Chrysler Corporation in November 1998 created Daimler Chrysler created a new global registered shares. Global registered shares are traded globally in different currencies. So in that sense, they are different from ADRs. Okay? Global registered shares are fully fungible. A global registered share purchased on one exchange, for example, in Tokyo, can be sold on another exchange, for example, the Toronto Stock Exchange. The main advantages of global registered shares over ADRs appear to be that all the shareholders have equal status and direct voting rights, while the main disadvantage of global registered shares appears to be the greater expense in establishing the global. What is what what is the empirical finding on cross listings and ADRs, or what are the empirical findings? Okay. Several empirical studies document important findings on cross listing in general and on ADRs in particular. And we have a couple of examples here. Ammer and others in 2012 found is whether the firm cross-list on a U.S. exchange. A second study in 2016 by Sarkisian and Schill established that cross-listing occurs in waves at the host market, home market, and industry levels. Uh, Jahiraman, Shastri, and Tandem in 1993 interpreted their own findings as evidence that an ADR listing provides the issuing firm with another market from which to source new equity capital. Results The results of Berkman and Nguyen in 2010 indicate that cross-listed firms from countries with improvements in domestic liquidity in the first 2 years after cross-listing, but tend to diminish later. International equity market benchmarks. As a benchmark of activity or performance of a given national equity market, an index of the stocks exchange or exchanges of a country is used. Now, indexes are constructed and published by Morgan Stanley Capital International, or MSCI, are an excellent source of national stock market performance. MSCI presents return and price level data for 23 national stock market indices from developed countries, 27 emerging beyond traditional developed and emerging markets. MSCI also publishes a market value weighted world index representing large and mid-cap stocks across 23 developed markets. And that index includes approximately 2,600 stock issues of the major corporations in the world. MSCI also publishes several regional East Index, the North American Index, the Far East Index, several European indices, the Nordic Countries Index, the Pacific Index, and the Emerging Markets Index. iShares MSCI. BlackRock Incorporated, an international investment management firm, a huge international management firm, operates iShares MSCI as vehicles to facilitate investment. iShares baskets of stocks designed to replicate various MSCI stock indices. Exchange traded funds with most trading on NYSE Amex. In other words, the iShares cover exchange traded funds with most trading on the New York Stock Exchange and the American Stock Exchange. IC shares are low cost, convenient way for investors to hold the factors affecting international equity returns. What are the drivers of international equity returns? What are the determinants of international equity returns? Okay. Here are the factors that have been found to be the important determinants of international equity returns. Macroeconomic factors are extremely important. Well, class, I'm sorry. I lost connection there for a while. Okay. Anyway, I was trying to explain that these are the three determinants of international equity return, and the industrial structure of the underlying economies. Now, two studies have tested the influence of various macroeconomic variables on stock returns. Solnick in 1984 found that international monetary variables had only weak influence on equity returns in comparison to domestic variables. Asprem in 1989 found that changes in industrial production, employment, and imports, the level of interest rates, and an inflation measure explain only a small portion of the variability of equity returns for 10 European countries, but that substantially more of the variation was explained by an international market index. Now, what about exchange rate? Well, Adler and Simon in 1986 found changes in exchange rates generally explain a larger portion of the variability of foreign bond indices than foreign equity indices. Hearn and Resnick in 1988 found that the correlations among major stock markets and exchange markets are relatively low but positive. Gupta and Fineri in 1992 exchange rate risk is generally not priced. Leon and myself, but okay, I had to insert myself in this discussion. I'm sorry. So Leon and myself, 1996, we found that yes, exchange rate is priced, right? But if you can build a well-diversified portfolio of ADRs, you can diversify that exchange rate away. Now, this study is available. If you're interested, I would be more than happy to send you a copy, to email you a copy of this study here. What about industrial structure? Studies examining the influence of industrial structure on foreign equity returns are mostly inconclusive. Some studies have found evidence in support, while some other studies have found evidence against. This concludes as an individual. Bye now.